Hey folks, welcome to Concept. Welcome back to yet another video. Today we will learn how can we go ahead and make more returns from the same stocks that we are holding in our portfolio. So we will be learning about how can we go ahead and use options to overlay on our portfolio in order to make more returns from the market. So we will learn about covered call option strategy, how the strategy is constructed, and what is the best time to typically practice something like a covered call. So to start off with, what is a covered call and why do we need it? So let's say architect. So you can just use the search panel to search the architect analytic. The link would be there in this thing description box also. Just go on custom strategy, select any stock that you're holding. Let's say for an instance TCS. Okay, and assuming I have TCS in my portfolio, so I am selecting futures. Sorry, so let's say TCS. Let's say futures and buy. Okay, assuming that I have roughly around 150 shares of TCS in my portfolio. Now this is how it looks like. So it is basically a simple future ka payoff, which is the architect is trying to show us. What is this? It is trying to show us on what various levels of TCS, how much profit or loss we might end up making. So with investments with equity, it is very simple. If you have bought it, only it will make you money if the market goes up. If you have sold it, it will only make money if the market goes down. Elsewhere, if the stock remains like this, you're not going to end up making money when you are investing or if you have created a future trade. Why is that happening? Because these are not sensitive to the option Greeks. Theta, Vega, IV, all those impacts won't happen on the future or on our investments. So now, in order to benefit from this components of options, we can obviously add some of the option strategies, or we can create some of the option strategies so that theta or vega, something like this, will start benefiting us. So let's quickly understand what is theta and how can we go ahead and use theta in order to make more returns from our investments.
Hey traders, Quantsap has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
So theta is how much premium will decay from your option strategy if that option strategy is held for one more day. Today the premium is 20. Let's say theta is 5. That means if you hold that strategy or you hold that option till tomorrow, that option will be quoting around 15. 20 minus 5, whatever the theta was, the premium will be quoting around 15. It is assumed when we are looking at theta or any other option Greek, it is assumed that the market might remain where it is, IV might remain where it is, that it is assuming that most of the factors or all of the factors in the market are remaining constant. Now, assuming that if all the factors in the market remain constant, but still the time is going to pass away, right? Every passing day, the premium is going to get decayed. So what we are trying to do, we are trying to capitalize on that premium, what is decaying. How can we do? Just click on add leg and just sell a call option. Why not put? Because the put option is a bullish strategy. If I go ahead and sell a put option as well, then it won't make any sense, right? Because I am creating the same trade over and over again. So what I'm doing, I'm selecting a call option, going slightly out of the money, 30 to 40 call option, I am selling it and just click on add. So this is how a covered call will get created. Now, what is the benefit of this strategy? The benefit of this strategy is suddenly you have started to receive theta benefit. Now, more you hold your investment, this strategy will keep on giving you more money. Imagine when ITC was sideways, every time you did a covered call, then you would have consistently kept on making money. Now, even any which ways, right? So some might have questioned that what will happen if this one TCS will fall. Any which ways you are going to make a loss. If TCS falls, you are going to make a loss, right? Because you have a bullish strategy. Now, if you see at this level, 3029, you are making roughly a loss of 27,900, roughly around 28,000 at 3029 on a future, that is on your investment. Now if you do the same thing, let's say 2440 call, it will try to protect you, but to an extent, right? It will protect you, but if you see that it has reduced your loss by around 6,000 rupees, but it will be to an extent. Why? Because this premium, which is at 20.6, it can go up because sky is the limit when the option is going to go up. But whenever it goes to zero, it will go maximum to zero. Whenever it drops, it will go maximum to zero. That is the reason if you see the strategy has a flat top on the flat curve on the top. Why? Because it is trying to tell you that it won't make you more money beyond this maximum profit. Even if it goes up, it is 12,583. So why it is that way? Because this premium maximum, how much benefit it can give you? 20 rupees. It can go to maximum zero, and that is the maximum profit you can earn at that point. Now remember, while you are selecting a strike price, how you can go about it is you can sell an option till where you have a visibility of the underlying to go. If I'm expecting that the TCS might go to 30 to 60, I will go ahead and sell a call option of 30 to 60, because till that point I will keep on making money in the market. That is the first case. Now, what are benefits of this strategy? If the market oscillates, the theta is making money. If market goes down, it will protect me to an extent. Okay, this is not an insurance strategy. This is to generate more income. Now, coming to the last point, which is even if there is no movement happening in the market, still this strategy is giving me some returns, some or the other returns in the market. Last thing, if the IVs in the market drop, the strategy again will give me money. So this is one of the strategies. Apart from that, what a lot of participants could do is, and this is completely different. What is this? What I will show you now. It is a protected put. So what is a protected put or a merit put? So it is basically an hedge, or it is an insurance. Covered call is not an insurance, but this is an insurance what you are trying to create. Let's say I am going ahead and buying a put option. Let's say 3200. Let's say put, and let's select 3100 put. Okay. Now if you see your losses, they have capped after 18,000. Why? Because that is the put option what it is trying to protect you from the further coming loss. So two different strategies, both have different use case. Correct. First one is a theta positive strategy. This will be a theta negative strategy. Here you will be paying theta, there you will be receiving theta. Again, the use case is totally different, and depending on the market situations, both of these strategies play a big role when we are managing our portfolios, right? Because see, if you just invest, then you know only there would be a movement, only then you will make or lose money. But using these strategies, you can try and experiment on few more things as well. Last thing to remember, the quantities. Your quantities on the investment should be more or less somewhere around the lot size of the future. Okay. Or lot size of the option FNO basically. Why? Because it will not be very appropriately balanced if something is very high and something is very low. Okay. Somewhere around that. If it is 175, then somewhere around 170, 165 is good enough. But if it is 175, the lot size, and you are having only 75, then there is a big problem there. So do check out Architect, not just a covered call or a protected put. You can go ahead and analyze any of your option trading strategies absolutely free of cost. It is just the signups that you need. Just sign up and you can use the Architect easily. Link would be there in the description box below, and also it would be there in the iCard. So do check out Architect and analyze your strategies like a pro.